Welcome back to Finance News. It's been a hell of a crazy couple of weeks in the markets, with more red than Manchester United's current losing streak. This week we're covering all of the major tech earnings, discussing the possible recession and poking fun at some extremely bad stocks. Without further ado, let's dive straight into your headlines. As we reported a couple of weeks ago when it was still developing, it's now confirmed that Elon Musk will be buying Twitter. After some careful consideration, realising that they were not going to get any better offers and thinking carefully about their stock options packages, the board decided to accept the $54.20 offer per share to take the company private. With the backing of some major banks, Elon's put forward his all-cash deal and is set, in his own words, to unlock the potential of the social media giant. Although the deal's still yet to be fully completed, there's a $1 billion clause that each party would have to pay if they pull out at this stage. Although Musk is unlikely to face any issues being able to find that cash down the back of the sofa because he can just sell Tesla shares instead. It was made public this week that Musk had been causing the recent Tesla share price decline by selling $4 billion worth of company stock, which might increase by the time I upload this video. In response to the filing, Musk tweeted about the sell-off, stating that after April the 29th, there would be no more selling. Although that was done at 2 AM, so I'm unsure if that means that there's still more to come, or he's already done selling. You'll know more than I will by the time this hits YouTube. In other news, it looks like we're in a bear market for the time being, or at least a secular one. That's according to analysts from Wall Street. The markets have been in a free fall for the past couple of weeks, with big drops across the major indexes as investors panicked because of various factors. And we're also spooked by the Netflix results, which sent big tech dropping as if they were penny stocks. We've seen some recovery since, with the results of the major FANG stocks being relatively positive, but not a perfect set of results by any means from the big players who hold huge sway over the global markets. Sticking to the US, GDP fell unexpectedly this week at 1.4%. The negative growth rate in gross domestic product came as a surprise to the markets, which were expecting positive growth to be reported by the Commerce Department on Thursday. The fall marks the worst quarter results since the pandemic back in 2020, and was even worse than even the lowest estimates that analysts had expected. Remember that for a recession to happen, we need to technically see 2 quarters in a row of negative growth, which would not be good for anyone. However, you wouldn't have even noticed anything if you've looked at some of the overall prices of major stocks. Overall, the markets paid little attention toward the end of the working week and seemed more focused on earnings from big tech, which for the most part continue to defy gravity. On the subject of tech earnings, it was a huge week for the big stocks to report their earnings for the first quarter of the year. Up first, Meta Platforms, formerly Facebook, reported earlier this week and were met with a resounding bump in their share price. Earnings per share beat expectations, revenue was a slight miss, but daily active users increased and average revenue per user hit $9.54 against an expected $9.50. After the announcement, the shares rallied into a double-digit climb, almost 20% up, although the price of just over $200 still remains around half as much as the all-time highs that we achieved back in September of 2021. We're one more step closer to the metaverse, folks, and at least my portfolio got put back into the green. Keeping in line with positive results announced this week, Apple continued to show the markets how you make lots of money by selling almost everything. Revenues came in at $97.28 billion, which was an increase of 8.6% for the year, which beat most expectations across the board for their different products. iPhones still make up the majority of sales with a whopping $50.57 billion. The star of the show was the rapidly growing services business from customers with subscriptions to all of the Apple Cloud services. It grew 17% year over year to $19.82 billion. The company also announced a mega $90 billion share repurchase program to keep investors happy, and also increased their dividend to 23 cents. Yes, if you didn't already actually know, Apple is a dividend payer, even though it's only a very small yield. If you did get in early, you'd be very happy indeed. Shares are currently trading around $163 and are up 22.6% year to date. Now, possibly the weakest earnings were from mega online retail giant and cloud services giant Amazon. The business is currently trading down in after hours as I speak after announcing some pretty poor results. Shares are down around 10% after the company announced a first quarter loss, their first since 2015. However, it's worth noting that the cause of the loss is down to the evaluation of their investment into electric vehicle startup Rivian, which they wrote down to the tune of $7.6 billion. Looking further ahead, the company was less optimistic that it could maintain its speed of growth that it enjoyed during the lockdowns, where people were spending like crazy. Next quarter, the business expects to lose as much as $1 billion or make up to $3 billion, which is massively down from the operating profit of $7.7 billion that they achieved in the previous year. Alongside the reduced customer demands were massive increases in costs from energy. Yes, even Amazon has to pay their gas bill and it isn't immune to inflation. Wrapping up our headlines, let's now head over to our next news section where I look at the fails of the week, where things in the stock market world haven't quite gone to plan. Just when you think it couldn't get any worse, fails of the week. A popular ARK Invest Cathie Wood company and somewhat of a previously favoured stock on YouTube is taking a beating this week, and actually had share trading halted after its results scared investors and sent them running for the hills. Teladoc, a company which specialised in remote medical services made popular through the pandemic when it rose to fame, reported a huge write-down of an acquisition it made. The company, which makes up a large portion of ARK Invest's funds, is currently down over 40% for the week and 80% down from its all-time highs. The total value inside of ARK's funds stands at over $600 million and may fall even further. ARK K, the flagship fund which was popularised throughout the pandemic with market-beating returns, has sent investors fleeing, with it being down 60% year to date against the market, which is currently flat if you compare it to the S&P 500. Take this as your frequent reminder that actively managed funds with high expense ratios rarely ever beat the market in the long run. You have been warned time and time again. And another fail this week worth highlighting, just because so many people got caught up in it, is the consistent fail of Tattooed Chef. I'll never understand how such a poorly run company got so much attention from the YouTube finance community. But so many people got caught up, assumed that a frozen vegan food provider would suddenly go to the moon and not have any competition or issues growing. It's currently trading at all-time lows around $8, keeps losing money, and it's even lower than its $10 SPAC price when it was taken public. If you bought any of the stock, give your head a little wobble and stop claiming to be a value investor. Now on that bombshell, it's now time for your favourite section where we take a look at some of the best memes over on Reddit's Wall Street Bets. I've done all the hard work for you, so you don't have to scroll mindlessly. Enjoy. Welcome to the best of the bets. It's been a rocky few weeks in the market, and we're always told that cash is not your best friend when inflation's high, so we do the next best thing and we invest it into the stock market, right?
Wrong.
Possibly the worst deal of all history? With Netflix starting to lose subscribers and having to put prices up, it's official, they are joining the dark side. We're raising prices. Okay, I'll share my password. You can't do that. You were meant to destroy cable. We're adding commercials. I'm unsubscribing. I'm out. Just for the record, I pay for mine, otherwise my girlfriend would be very unhappy. I feel like I make the same joke every time in this section, but these memes just keep getting upvoted, so here goes. Remember, if Cramer mentions your stock, break out into a cold sweat, because if he likes it, it means it's probably going to go to the other direction. You have been warned, always inverse Cramer. And finally, I'll leave you with this one for the week. I've got nothing against you if you work at McDonald's. In fact, you'll probably end up getting some new colleagues soon who'll probably try and convince you to go short on French fries and go long on McFlurries. That's if the machine's not out of service on the hottest days of the year. If things continue like this, I'm not loving it. And on that bombshell, thank you so much for watching. If you want to catch up on any previous weeks of finance news, see the playlist on my channel. Otherwise, enjoy this next video. Drop me a like, subscribe for more, and I'll see you next week. And in the meantime, as always, happy investing.